Good morning, ladies and gentlemen. Hope everyone's well. McEwen Mining, what's it provide you? We're debt-free. We have leverage to gold, silver, and copper. So if hard assets are going up, we should do well. This is the safe harbor statement. I just want to say, if you're risk adverse, don't bother buying our stock. That's basically the intent of that. And don't believe anything we say, because that's what they'd like you to believe. When I'm looking for a gold stock, there are a number of things I look for, and I just wanted to share with you what I look for in a company. I look for the financial strength. Do they have enough cash to carry out their activities? Is there debt encumbering the balance sheet that might restrict those activities? I look at the operating mines and say, are they generating positive cash flow, earnings? Look at the revenue. Has it been encumbered by the sale of royalties or metal streams, or have they hedged it? In other words, have they gone and encumbered the upside? I also look at management and what is the depth of the management team, and also how much money do they have invested? If they're telling me a really good story, I want to know if they have a lot of money in the game so that we're both sharing the risk. Look at the growth of the assets. Is it negative or positive? Are they building their assets? And then one very important consideration is market liquidity. If you get in, can you get out when you want to? So are there a lot of shares traded? And does it have good leverage to the gold price? And the other is, are there some wild cards, some assets that don't seem to get a lot of profile, but in the right environment could become much bigger and more important to the company? And those aspects I'd just like to go through looking at McEwen Mining and its scorecard. So first, from the first perspective, financial strength, there's $55 million cash, US, and we don't have any debt. So the balance sheet's not encumbered. The cash has grown. And you can see in terms of, I hope you can see, that looking from the right to left, we're going from 2014 to 15 to 16, and it's probably in reverse order. It should have gone the other way. But you can see that the cash flow per share has gone from a -5 to +8. Earnings per share have gone from, there were some write-downs a few years ago, from negative to +7 cents a share. The working capital has gone up to $58 million, almost a double from the year before. Our book value has gone up, and we don't have any debt. Liquid assets are about the same as our working capital, and the average price of gold is pretty close to where it was in 2014. So we've been able to generate revenue, even though the gold price has, it increased over 15, but is basically the same as 14. We pay a dividend, or I won't call it a dividend, it's a return of income, but it's a penny a year, giving us a yield. And when I was running Goldcorp, I always felt it was important to pay a dividend for a couple of reasons. One, it's economic rent being paid to the shareholders while they're waiting for an increase in the economics of the company. It's also a very important discipline for management to say that you don't get to use all the money that the assets generate, that want to be more efficient with that capital. Looking at the next, looking at the operating mines, we have 2 operating mines that generated free cash flow of $25 million last year and earnings of $21 million. And you get a sense of how the free cash flow grew from 2013 to present. You can see the treasury has grown. And this has all been done without going to the market for a debt or equity financing, as I said, without selling a metal stream or a royalty, which much of the industry seems to be prone to do. In terms of our production, this year we're forecasting that 31% of our revenue will be coming from silver, just over 3.3 million ounces of silver, and 69% from gold, which is just under 100,000 ounces. And by 2019, we have some growth, so we'll more than double our silver, we're projecting, and our gold's going up by about 40%. Production costs came down in 2015, 2016. We hit some very high-grade ore at the bottom of one of our pits. This year, we're not benefiting from that high grade, but we're still coming in at reasonably good costs in the bottom half of the cost curve, with all-in costs at $900 an ounce in Mexico, and about 10% higher than that at San Jose. In terms of revenue, we don't have any limits on our upside. As I said, we haven't sold our metal stream, we haven't sold hedges, we haven't put hedges on, and we haven't sold royalties. In terms of management, again, when someone's pitching you a story, or at least when they're pitching me, I always ask them, how much money do you have invested? I want to see how serious they are about, are they really convinced that it's going to go? So in our case, I guess I'm the largest shareholder. I own 25% of the company. My cost base is $127 million. Those are after-tax dollars. And I happen to believe this is a good situation to have some money in. As you can see, the cost base, 127. I got a salary increase last summer. I now take $1 a year. And that was after 10 years of zero, so it was an infinite increase. And by election, by choice, I've taken no options, and I don't get a bonus. So what I wanted to do after running Goldcorp, I was the largest individual shareholder of Goldcorp as we were building it, and I wanted to evolve that model a little bit further and be right next to my fellow shareowners. I wanted to be there so that I'm going to feel the pain if the stock goes down, and I'm going to have a smile on my face when the stock goes up, along with the other shareholders. And I think it's really important to have that alignment, and I think too much of the industry has decided they want to take too much off the table before they've delivered to the owners of capital. Because without you, there are no public companies, there are no lawyers, there are no accountants, there's no stock exchanges. It's your money that's being put up, and you deserve to get the best treatment. In terms of our management team, we've added people recently in the last year that come from companies that have had much larger operations, that have operate open pit underground mines very successfully, that have developed projects. We have a project we're developing in Nevada, Gold Bar. We hope to start construction later this year. We have a silver project in Mexico that we'd like to start a year from now. So we needed these skills. We have another fellow who's just in charge with our Los Azules copper project. And he worked for Xstrata and was the person they used to go out and fix all their properties when there was a problem. In terms of growth, I'd like to look, Gold Bar, as I mentioned earlier on, it's in Nevada. It'll be a gold mine that we hope to have approved in the third quarter, start construction in the fourth quarter. And El Gallo Silver. And this is what our growth production looks like. We started with one operation in 2012 in Argentina and just began production in Mexico. So the dark blue is Argentina, the gold on top of it is Mexico. And we're nearing the end of the life as we currently know it in Mexico, although we're spending $6 million this year in Mexico to look for extensions of that ore body, but based on what we currently know, it's starting to tail off. The orange is Gold Bar. It's starting a full year of production in 2019, and then El Gallo Silver also in the gray. The development project at Gold Bar, one of the things I've always looked for, I've become more and more sensitized to governments changing the rules. The mining industry happens to be on a one-way street. You go into a country and the country asks you to post bonds for environment and other. They ask you to put money into the local communities, which the government should have done themselves. And then they ask, they'll change the rules. They'll change the tax rate. They'll change the interest that they have in the property. And to me, that's a one-way street, and the industry should be pushing back and look for a little more equity in this situation. Governments aren't apt to do that very often. So my way of dealing with that is saying, when we want to build a project, it has to demonstrate it can deliver a 20% internal rate of return after tax. Then you get your money back in 3 years. So I'm trying to protect ourselves from avarice governments that change the rules. And Gold Bar meets that quite amply. You can see this sensitivity chart. Bottom, the after-tax return is modeled at 20% at $11.50 gold. At current prices, it's a little bit better. The payback is less than 3 years. The Gold Bar property is in a very famous district in Nevada. It's in the Cortez Battle Mountain Trend. Above us is Barrick's Cortez Hills, and also their largest discovery in the last year. This is their largest source of production in the world, gold production. So it's a good neighborhood to be in. And we're going to be here for 6 to 8 years based on what we currently know. We hope we can be there much longer. Our other area of growth is our silver project in Mexico. We discovered it in 2009. We were given a permit to construct it in 2015, and we chose not to build it because the silver price had dropped considerably, and the project would not generate that 20% return after tax. So we said, well, the silver's not going anywhere. So let's just leave it in the ground and wait for a higher silver price. I'm a big believer that silver and gold are going higher, and why would we raise money at the bottom of the silver market, dilute everybody excessively, and build a project that has a single-digit internal rate of return? So this one needs about a $21 silver price per ounce to get it going. Market liquidity, we have 300 million shares outstanding. We trade 4.3 million shares a day. 95% of our trading is on our New York listing. You can see here our market cap's just below $1 billion US. 304 million shares fully diluted. And you can see there's been some very big spikes in our volume. We're in about 47 indices, and if you look at the market today, it's changed dramatically from what it was 10 years ago. More and more money is moving towards passive investment vehicles like ETFs and indices. So I think it's really important to be in a lot of indices, but it can also cause huge spikes in your volume. You can see we're almost, the left-hand scale on that chart on the lower left is in millions of shares on a weekly basis. So we've been touching up to almost 80 million shares in a week. That's extreme, but nevertheless high. Our stock has a very high beta to gold, and this really, it's one of the highest on Bloomberg when they measure the betas, and that's really, if gold moves, how much do we move? And this is a double-edged sword, because if gold's moving up, we tend to run a little faster, but if gold's moving down, we also run faster in that direction. And you can see our share price. The company started out called US Gold. I bought into it in August of 2005. My first investment was at 36 cents, and 7 months later we're almost at $10. There was some irrational exuberance there. We came down with the financial crisis, then we went back up on a silver discovery, then we came back down in the summer of 2015, and we've recovered nicely, but along with the rest of the market. In terms of wild cards, we have a very large copper deposit, and not a lot of people are giving a lot of credit to copper right now, but let's just take a look at it. It's located in the Andes between 3,500 and 4,000 meters above sea level. It's in the province of San Juan, which is northern Argentina. It's right close to the border with Chile. This deposit, well, it's a resource right now, is between all categories of resources is 20 billion pounds of copper, about 4 million ounces gold, about 100 million ounces silver. I just want to shift your perspective for a moment and say, if you were to convert this copper into gold, this would be the equivalent of a 40 million ounce deposit of gold, just to give you some sense of the magnitude of this deposit. We did a preliminary economic assessment on it back 3-4 years ago, and it was going to be producing about 500 million pounds of copper a year under that scenario. Unfortunately, the cost of bringing it into production was about $3.9 billion. Let's call it $4 billion. You just saw our balance sheet was 55 million. So it wasn't something we were going to develop right away, but it is a large asset. And with the changes in the government in Argentina last year, we were able to change the process here. And we can now look at dropping that capital cost to well below $3 billion. And we think later this summer we'll be putting out some reports that show where we think the economics are. We're drilling on the property, expanding the resource right now. We're looking at all the infrastructure needed. We're looking for a joint venture, possibly. Or if someone came along with a good price, possibly a sale on this. This is just a picture of the infrastructure where it would be placed in this area. And I'll just say that's our wild card right now. If the gold and silver market take a while to go, but the general economy moves, then we're going to be looking at copper moving up faster, and the value of this increases. I just wanted to look from January of 2016 to present. You have gold and the Dow. There's a lot of attention with the Dow right now, but if you look at the two bottom lines on this graph, you can see that the Dow and gold are about the same performance since the beginning of 16. The gold shares have come down, but they're still well ahead of the Dow, and I think it speaks well to the future of this sector. President Trump is determined to make America great, and I think a lot of the actions he's taken have been extremely positive for the economy, and certainly the market's telling you that. Despite all the rhetoric about what he says, the market is saying that he is making big changes, big positive changes, reducing taxes, hoping to reduce regulation, encouraging business, repatriating funds from the multinationals, and the market loves it right now. But he's going to create a lot more debt. This graph is showing the debt that America has, national debt of $20 trillion. If interest rates start moving up, that's going to be harder to service. And that, under Obama, that number was going to 26 trillion by the congressional office's estimates by 2022. That's without the stimulation that's going on today. A favorite chart of mine, just gold and the Dow. It takes the Dow and divides it by the price of gold and plots it, and you can see 3 major cycles. So one day it's going back to 0, I believe. And so that's our scorecard. We have lots of cash. We don't have any debt. We have free positive cash flow, earnings. We haven't sold the upside. Large management investment. We have growth. We trade well, and we have a large copper deposit. And in terms of upside, this is just looking from the highs that were achieved in 2010, 2012. how much room we'd have to go to the upside. Right now, we could go up 180% to get back to our old highs. Franco, Nevada is above its old highs. Thank you.